Awesome to be here with everyone this evening. We're just here to talk about our solutions that are designed to help you guys offset the unsustainable increases in the insurance market as well as the decrease in benefits. So, Jen, if you could go to the next slide.
Sorry, Scott, I'm having just a little technical
Oh,
difficulty.
no problem. So the first thing we're going to talk about is just that we want to point out that our biggest goal is not just to be a product and price broker, although we want to do that really well. We also want to understand your goals, how important your benefits are to overall retention and attraction of employees, how you're doing technology, compliance, all the things involved with employee benefits. How are you educating new hires? How do you do open enrollments? When do you like to start working on your renewal? All of those types of things. So we want to ultimately go through a process where we ask you how you're doing things now, and then put together a proposal that not only includes product and price, but also includes all the other areas that a professional employee brokerage firm um, should do for you. And we are approaching this relationship, no matter how many employees you are, we're trying to approach this relationship as if you were 1,000+ employer group and give you those type of tools and resources. Next slide, Jen. So this slide, just real quick, you probably all know this, but it just points to the unsustainability of businesses having to pay for insurance for employees. This specifically talks about health insurance. You'll see about 25 years ago, it was a little over $5,000 to insure a full family. And today, it's 25,000. So the premium to insure a full family in our country has gone up 5 times in the last 25 years. But what a lot of people don't talk about is the deductibles in the out-of-pocket expenses have actually gone up double of what the premium has gone up. So we're all getting hit on both ends. We're getting hit on the premium, but we're also getting hit on the out-of-pocket max. Next slide. Okay, so this is basically where what our differentiator is, and we're going to talk about like what our short-term strategy is and what our long-term strategy is with GPOphtho. Um, but you guys are probably all familiar with the reactive renewal process, where you'll receive your renewal 45 to 60 days prior to the effective date. And then essentially what happens is you have to react to an increase. And companies typically do this in three ways. If they get a small increase, say 0 to 8%, um, and I don't mean 8% is small, but unfortunately for the health insurance industry, it's not huge. Um, then sometimes the companies can absorb that increase. But if the increase is unmanageable, option one is to increase copays and deductibles, so making the insurance plan worse so that you can control the cost. And then the other option is you pay less and as an employer and push more cost onto the employees. So these are the three things that almost all companies do at renewal. And we want to show you how we can establish different levers that you can pull to kind of bend this curve back in the right direction. Jen, go ahead. So this slide alludes to that. We call it the spectrum of risk. So what we found is most ophthalmologists have less than 50 employees, and most of them fall under the first column there, which is fully insured. And so what that means is that you pay premium to the carrier, And at the end of every month, at the end of every year, it's gone, regardless of how your group performs. So if your group performs really well, you don't get money back. But on the positive side, if the group performs poorly, you don't have to pay any extra money. But this is the exact scenario that I described on the last slide, where you have no control over how to address when that renewal drops. You're just basically subject to whatever the rate increase is, and you have no additional levers to pull when that renewal drops. So, what we really try to do with innovation in the step one of our relationship with GPOphtho is trying to look at some alternative funding, alternative ways that you can fund benefits even if it's very subtle. So, what the first slide talks about is you still remain fully insured, but most of the time, what we suggest is to buy the cheapest health plan you can from the health carrier. So, the health carrier is still going to cover all your major events. But then what happens is with that money differential between your plan today and the cheaper plan that you purchase, which usually has the same network, same doctors, it just covers less. What you do with the extra money is you start to fund the smaller stuff yourself. And you can do this in through health savings accounts, flexible spending accounts, and a unique thing that we offer called the participating funding arrangement. But essentially what you do is you don't pay the for the small stuff through your insurance carrier. And in its simplest form, you create a fund of money so that when the renewal drops, maybe you haven't or your employees haven't used the insurance very much that year, or you have extra money in your HSA, whatever strategy we use, so that if you get a 10% increase, you can offset that increase by money you have left over in these other funding options, right? So that's its simplest form. The bar next to it is it's called level funding. So we would still use the HSA, FSA, or participating funding arrangement, but instead of having a fully insured plan, we'd use a level funded plan where the carrier would disclose the claim fund to you as well. So what that means is if you had any money left in your claims fund at the end of the year, they would also give that money back to you. But the nice thing about level funding for smaller businesses who can't do self-funding plans is that what you pay in premium every month is your maximum exposure. So even if you do have a bad year, you don't pay more in premium. So the basic concept of what I'm explaining is bars two and three can be executed even in companies with less than 50 employees. Um, but what they do is over the long term, you will notice they start to significantly outperform bar number one. And then the last bar is the long-term strategy, where eventually, once we get enough lives insured, we can actually look at doing a large group, self-funded type of captive plan for GPOphtho, where very little of the money that we pay is fixed, and it would just be like a large group self-insured plan that you'd see at a 500 or 1,000 employee group. So that's the long-term vision. Next slide, Jen. Okay, this is just really quick. This is something that you can do right now. Most of you with even less than 50 employees, it just shows the same thing. On the right is where 98% of groups under 100 are. They're fully insured. It's 100% non-refundable. You can do the same thing. You save money right off the bat on the left because there's a lot of fat in the fully insured. There's profit, there's taxes that you get away from. And then in the orange is variable because it's a claims fund. And a lot of the carriers that we use, they'll give you 100% of that money back. So the only fixed costs are the bottom two bars versus on the right, it's all fixed. Next slide, Jen. This just talks about health savings accounts, just general education. But the biggest thing since is that they're triple tax advantaged. So when you put your money into an HSA, it is tax free when it goes in. And then maybe some of you know, maybe you don't, but a lot of them today, you can actually invest that money in mutual funds, ETFs, just depending on who you have your HSA with. And the investments grow tax free. And then when you submit a qualified medical expense for reimbursement, you also get that money tax free. So they're triple tax advantages, and it's an excellent way to take advantage of tax advantages. Jen, um, things you can spend your health savings account money on would be your typical, your medical, your vision, your dental, but also things like alternative care, chiropractic care, acupuncture, sometimes massages, mental health, and also a lot of personal health issues. So really great, simple strategy. But what you'll find is that after you've had one of these in place for 3 or 4 years, compared to paying for a high-end PPO, you'll be way far ahead 9 times out of 10 versus paying the insurance company to cover all these small expenses for you. Next slide. So just an interesting strategy is that the HSA, some of my coworkers have taught me this a few years back, but some of them actually were showing me that the HSAs, they do not have any statute of limitations of when you can turn in the receipts as of now. So what that means is if you wanted to, you could fully fund your HSA on a triple tax advantaged strategy. And what you could do is pay for your medical expenses still with regular money now, today, so that your HSA grows tax free. And then and then just save a good record of receipts so that at any time later in life, you would be able to get all this money that's grown in your HSA tax free. Where I'm not comparing it, 401k is great too, but with a 401k, you don't have any receipts to offset it, the investment returns. So it is taxable when you take it out. So it's just a different strategy and a way to use these funds. Uh, Go ahead, Jen. Real quick, I mentioned the participating funding arrangement in the same family as health savings accounts, same family as flexible spending accounts. But the big thing with this is that for your company, um, what you would do is instead of buying a high-end health plan for your employees, you would buy, again, the least expensive plan. It could be the same carrier, the same network of providers, but you pay a lot less to the insurance carrier. And then you create a fund using the participating funding arrangement. But the biggest difference between this and the health savings account is the health savings account. If you did give that money to an employee, it's their money. And with this strategy, you still have a promise to pay concept for insurance claims, but the money remains with the company until the claims are paid. So it's typically you only spend about $6, 60 cents for every dollar that you would give to the HSA because employees don't use that much in claims. And it also improves your cash flow because at the beginning, when you first start using it, there's a significant lag time on insurance claims. So we would think that in the first year, your cash flow in terms of insurance would improve by 15%, and the premiums are usually 10% lower. So what we'll typically see is if you go out 3 to 5 years, which I know from most of the clients that brokers work with in insurance, they're just trying to live one renewal at a time. We don't really try and think like that. And what we've consistently seen with these strategies, self-insurance strategies, is when you go out 3 to 5 years, the people that execute strategies like this, they're killing the regular market in terms of the quality of their benefits and their premium. Next slide, please. Um, okay. And last thing we have, this is an example of a group we executed the strategy with. They had 20 employees in Texas, and they were fully insured before they met us. They had a $3,500 deductible, and after co-insurance, the employees could actually be out of pocket $9,100. And the total spend for this plan for 20 employees was $195,000 a year. The practice manager was at a meeting like this. He was open to these type of strategies. They went with us on 4/1 of this year, and what happened was the premium was a 12% decrease. So it went from 195 to 171. So what I tell people is it will typically, if you think about it in a time span, it will typically take a company like this 2 years before they even get back to where they were when we first met them. But equally exciting is by using this strategy and creating the fund, we were actually able to cut the employees out of pocket max from 9,100 to 3,850. So kind of like Tony was talking about earlier, we know that there's a lot of staff and regular employees out there that are living paycheck to paycheck. And if they have a serious medical event happen and have $9,100 out of pocket versus 3,800, that's the impact of that is like giving an employee a significant pay raise. The next slide. So yeah, if you'd like to have a meeting with us just to discuss a little more, here is my contact information, and we're just really excited to see if we can help you guys just improve your situation, not just this year, but make a plan to outperform your competitors over the long term.